Welcome to Founders Unplugged, hosted by Greg McCallum. Long-form, honest conversations with founders and entrepreneurs from around the world.
Kealan, I guess I'll let you talk about Symvan because it's your company. But for myself, for my part, in terms of my background, I've been at Symvan for a long time. But before that, I guess originally I read English for my undergraduate, and then after that, did a law conversion course, trained as a barrister, but found myself miserable enough that I didn't want to carry on doing that for too much longer. And partly fueled by just having, like I said, a really not great experience at law school. I really tried to find something that was a total antidote to that. And that's what led me sort of by a bit of a circuitous route to today, because my sort of gateway into it was doing a short stint at an ed tech startup. And that really was kind of a light bulb moment. All the things that people talk about with startups, it's dynamic, forward-looking, creative problem solving, rather than most of what I'd experienced with the law, which was very stolid and stale and backwards looking. It doesn't have to be like that, but I found that a lot of the stuff that I found myself doing, and the prospects for what I would be doing for the next 5 to 10 years if I'd stuck with it, would have been very much in that cadence. Went for something completely the opposite, the antithesis of that. And once I had that, it was only a couple of months at an ed tech startup, but it really did open my eyes to a much more flexible and dynamic way of working. And I was looking for more of the same, to be honest with you, looking for other startups to get involved with, or to go down the founder route myself. Looking for, maybe technical co-founder to start work on a couple of ideas I had. But, and it was while I was casting about looking for something like that I was put in touch with Kealan and Nick, Kealan's co-founder, who at the time sort of could use an extra pair of hands. And I needed a bit of experience because I didn't have anything in this space. I thought it was going to be I started out as an intern, and I thought it was going to be a couple of months just adding a bit of something onto my CV. And like I say, I'm still here and part of the furniture nearly a full decade later, which is, how these things sometimes turn out.
Blink twice if you need help. if you need an escape. Yeah.
I'm Kealan Doyle. I'm a co-founder of Symvan Capital with Nick Nicolaides. Nick and I have worked together for 20 years, and we originally started. We were working at a corporate finance house in the mid 2000s, and we were doing working with not just technology, which is what we focus on now, but also mining, oil and gas, that kind of thing, renewables. We were corporate finance guys who were doing IPOs, placings, that kind of thing, typical corporate finance work, and we had some interesting deals. One of them, for instance, in clean technology, was the first biomass IPO in Europe. When was that? That actually happened a week after Lehman Brothers failed, which was not a good time in financial markets. And somehow we got it away. But to be honest, it was largely pre-placed. So the tumultuous events of those days were largely irrelevant. But of course, then the IPO market died for about 4 years after the cataclysmic 2007-8 period, and we founded Symvan in the early 2010s, whatever that decade is called, 2013 was when we incorporated Symvan Capital, and our idea at the time was, and we moved into the EIS and SEIS space. And our idea at the time was, we were looking at the market and we were seeing people, given that it's a risky asset, we're not really aiming for the kind of returns I think are, commensurate with that kind of risk. And we were quite unusual in the EIS market at that time. We were talking about, to make it simplistic, rather than talking about IRRs, we were talking about, we'll take £1 and turn it into 285. Now the most of the market was talking about we'll give you a 105 back 110, and it was an asset back market largely. There was no one in the market that was talking about a 285. No one, absolutely no one. Now it's everybody. To be honest, the 285 target, which is roughly, depending on when you get your exits, we call it 285 over an average life of 7 years, because it's impossible to time when exits happen. That's assuming if you would, rough assumption is low 20s in IRR terms, which I think is commensurate with the risk that your one is taking, particularly when you factor in the tax breaks. So we started off small, and we're still niche. We value performance over. We're not a marketing machine. We're a performance machine, and I think our performance is kind of bears that out.
Wonderful. Well, thank you both for your introductions, and thank you both for being with me. I really, really appreciate it. Lots of questions that I have to ask you based on those introductions. Look, really quickly before we delve into Kealan, what you were talking about, the enterprise itself, and I've got lots of questions about that. Just really quickly, I'm interested to know what is it about the startup world specifically that really appealed to you and sort of made you want, aside from some of the stuff you touched on there about maybe the slow sort of, I don't know, slightly overly academic, backward-looking nature of law. What were some of the key attributes that really made it stand out to you?
Yeah, well, for me, I think why VC has been a really good fit in the end is that, what attracted me to the startup space, and it was always in my mind, technology that was the bit that was attracting me.
Right.
Technology as a sort of a force multiplier for some kind of change, some kind of impact, and that doesn't necessarily need to be impact, I guess, with a capital I, in terms of something with a social benefit, just driving us forward, increasing the size of the pie, all this kind of thing, actually contributing and growing things. And technology was the sort of force multiplier for that. So it was always technology that I wanted to get involved with, and getting right at the heart of things, at the coalface, with the very earliest stage of that has, like I say, perfect fit, because that's when you're really having to test your assumptions, really having to kind of start putting these ideas into the real world and see if you can make them something real. That's always been a big part of it. And like I say, YVC has been a really good fit for that. As I said, I kind of made this decision, embryonic though it was, that was something I wanted to really try and forge a career in. It never occurred to me at that point that VC would be a career path, but actually it suits me down to the ground personally, because instead of, I guess, putting all my eggs in one basket of a single venture that's trying to do whatever it is that it's trying to do, I'm now working across a couple of dozen companies, a whole host of smart people, brilliant founders with great ideas, and helping them all try and bring that into existence and to grow it. And it's tied very closely into our investment approach, which is to be very hands-on with our companies. I don't think I'd necessarily feel that same pull if it was just all right, I'll do a bit of due diligence and write you a check, and then we'll see what happens. The fact that the Symvan approach is to be very involved with our companies and really kind of go through those early steps of the journey side by side with them. Like I say, it really ticks the boxes of what I was looking for in this. And yeah, the gratifying thing, sometimes maybe it's a bit trite, but I sometimes talk about it as being similar to what people sometimes get out of something like gardening. You put effort in and it takes time and not all of it works, but the gratifying thing is actually seeing stuff grow, basically. So, and again, for me, I don't think I would get the same satisfaction out of it doing something like traditional private equity, where it's much more on rails. It's much more about the numbers and just can we grow them and can we maximize this? It's messy and therefore often pretty chaotic and stressful at this end of the market when we're doing, we've got pre-seed up to Series A, but that pre-seed, some of these companies, most of them are before revenue. Some of them are even before they've finished a product. So they've got everything to do. It's all uphill. And so I really enjoy just that mucking in and seeing if we can make stuff work and actually establish it and grow it.
The most chaotic time for sure. But yeah, I mean, it sounds like you've pretty broadly covered, I think, the reason why most of us are in love with the startup world, the ecosystem. It's like magic. It's like, yeah, just ushering in things into existence that didn't previously exist, which is just, it is, it's nothing short of magic, right? From your point of view, Kealan, were there any benefits to bringing in someone, Michael, with his background? Did you utilize his background, and was that useful for you, Michael, like given your background in law, or did that not play a factor at all into it?
No, it did. I mean, we look for investment managers, or for that matter, any member of staff to have it. I don't want to say diversity because that's such a sort of trendy word, but different skills. And
I like the word. I like the statement diversity of thought. I think it's more honest.
Yes, I think it is more honest actually. Yeah. And yes, so Michael brings that element that that wasn't Nick. I mean, Nick and I both started off in large investment banks.
Right.
And we're finance guys through and through. And for Michael to come in with not a background in finance but within law was an interesting addition, and I think it's worked out very well. As Michael said, it's hard to believe now, but almost a decade. No, it's very interesting, and it comes in so useful because a lot. Well, there's no use pretending that startups is all. I mean, there's this Hollywood idea of it's a trajectory up, a straight line trajectory to unicorn status, and the reality is that it's a roller coaster, and a lot of it is.
So when you say about your backgrounds, you and your co-founder, then how did you find the transition from that more institutional approach to finance and investment banking and so on to startups? Was it what you expected, or were you pretty floored by the culture shock element of it and all of that? Like, how did you find that transition?
It took about 2 years to recover from large investment banks.
Right. Was it bad from a bad habit sense, or just a perspective shift, or all of the above?
Well, no, it's just it's in one sense the startup world is it's much more exciting, but it's also much more volatile and crazy, if you like. It's but we embrace it fully. I mean, it did literally take take a little while to just to get used to it. But I'm not sure if we still are used to it in some ways. But still, as you indicated a little earlier, there's nothing quite like nurturing a startup and having it become successful. It really. There's a lot more satisfaction in it, I think, than just what happens in investment banking is you're very transaction oriented. One transaction finish onto another. This is a very different approach, right? You're working with the company, particularly if you're activists. Now, a lot of VCs are what we would call somewhat pejoratively spray and play. And we have a different philosophy, but it's very much as Michael indicated earlier, getting involved with the companies. And that can be a source of grief, but it can also be a source of joy. So
right.
It's a very, very different approach to finance. But having said that, a lot of the stuff that we learned in doing corporate finance work and doing the derivatives and technology IPOs and whatever really is applicable here, particularly when it comes to exits. You really see that, and Michael's background is also very useful because we're in the middle of a never-ending exit that's hopefully going to end by the end of this week. But there's all sorts of components in there. There's anything from valuation to legal questions to indemnities, etc. And I think if you haven't, you need at least someone on the team who or if not more than one person that is experienced with that, because selling a company isn't easy. And at the end of the day, our investors, or any investors who invest, whether it's a traditional VC, like sort of LPGP structure, or an EIS VCT structure, at the end of the day, exits are what matters.
Yeah, absolutely.
I think that, I never worked in investment banks or anything, but from learning from what you and Nick brought to the business, Kealan, not to make us sound like total squares here, but I think it brings a degree of sort of rigor to our approach. Again, maybe that just suits me because I'm just that way inclined. I'm a bit of a pedant. I don't know, but I think to the point you made before, Kealan, about some of the kind of public perception of VC, a lot of it feels very sort of freewheeling and kind of shooting from the hip and gut feel. And I like the cut of your jib, so I'm going to write you a check. The kind of, Masayoshi Son deciding in the back of a car that he was going to invest in WeWork and that kind of thing.
Hi, a friendly reminder to share this episode with your network, like and subscribe. And if you are feeling really supportive, please consider reviewing the show on the podcast platform of your choice. It all really helps support what we do. Thank you. Now back to the show.
And I think, I imagine that a lot of people sort of play up to that trope because that's what they see and that's how they think it works. Whereas, and again, I can't really speak about other people too much, but I think the background that you've brought to it, Kealan, you and Nick, that institutional, as you said, Greg, heavy FCA regulation, the kind of compliance thinking that's just deeply ingrained in you. Again, it doesn't make us sound particularly fun or sexy, but I actually think it does. It provides a really good platform. And at the end of the day, it is financial services. Just because it's financial services, a lot of people imagine against backgrounds with sort of neon signs and things like that. It's still a risky financial product that the FCA is very, very hot on regulating closely. So, yeah, again, maybe it's just partly my natural characteristics, but I've found fitting into an environment where you've brought that level of kind of rigor and professionalism to it. Not to say that others are unprofessional, but yeah, I've found
it's a different approach. And I imagine you've all grown together and learned together in this space anyway over this 10-year journey, right? I mean, there's so much to learn that you then bring to the table individually. It's interesting what you say though about the perception of VCs sort of being this sort of shoot from the hip, making deals in the back of a car or on the back of an napkin type thing, because of I'm a bit torn on this. In some ways, as you know, I'm on the raising journey at the moment, and we're pre-seed, pre-revenue, and I get the impression that there's a lot of funds taking. And I've known funds for a very long time, fund managers and LPs and all sorts. And it used to feel like that was more the case, especially at pre-seed, pre-revenue, where there was a bit more of this approach of just like funding great ideas, from great founders, because that's all you have. That's all you have. You should make quick, fast decisions to get capital in the hands of founders who have got great potential, great ideas, to get them to market as quickly as possible. And then after that, maybe slow down a bit and do your due diligence. Fine. But it seems like, it looks like we've lost him. Bad connection. He'll be back in a minute. But it looks like at the moment now, I mean, maybe it's since the pandemic that shall not be named, that now the due diligence is just extraordinary at the earlier stages, to the point where I think it's really it's causing issues because there are so many great founders out there now that feel like they have to train themselves, create 1,000 different documents and do all this due diligence, create a data room, and it's just like, come on, man, it's just an idea. Give the guy some money if you believe in him. Do you know what I mean? I don't know. I'm just curious to know what your thoughts on that, given your position.
Yeah, it's a really good question. I think it is going to depend on your approach as an investor. I think if, as Kealan was saying, don't want to sort of disparage people unfairly, but if you're the kind of investor, which is perfectly legitimate, that you write a bunch of checks and it is just, there you go, see what you can do with it. And I think if that's your approach, then I totally agree with you. Why are you putting companies through the ringer? Because at the end of the day, what possible, people talk a lot about picking winners and identifying companies, and really, what is your predictive abilities when you're dealing with a company that early? I mean, it's almost negligible, your ability to forecast what's going to happen to that company across 3, 5, 7, 10 years. We don't forecast the weather more than a week in advance. So it's a nonsense to say that you really picked out something that gave you any degree of confidence that this was going to win. So in a situation like that, I would agree with you that I think there probably are some people out there who are, because it's a very competitive market, have kind of put in these arbitrary ways of filtering people out and putting them through their paces. And I think, if your approach is to be a bit fire and forget about it, then I'd agree with you. However, I think that's a minority. And I think the way we look at due diligence, we spend a lot of time on due diligence, and we go deep, even at the early stage, or at least as deep as you possibly can. Obviously, there's no historic financials to pore over and things like that. But for us, there's a sort of due diligence framework that we put everyone through. And the way we often think about it and talk about it is that it's less the answers to the questions that are important. The contents of the data room, yes, we're going to look at them, we're going to interrogate them, and if anything comes up, we'll follow up on it. But as much as anything, it's an exercise in getting to know the founders, because as you said, you're backing founders at that very early stage more than business models. You got to understand the business model, but there's every chance that's going to change. So you've got to try and understand the founders as much as possible. Part of that is just getting FaceTime with them and finding character fit, because again, like what we've said about working closely with companies, you want to get involved in a potentially 7, 8, 9 year relationship with a company and you don't see eye to eye. But also seeing how they answer the questions. If someone is very good about getting a data room together quite quickly and neatly and professionally, and they've got the answers to their fingertips, that tells me a lot about that founder. That tells me a lot about their application and their dedication and how much they've got their shit together, basically. So, but I appreciate that, we do that, and we front load a lot of that due diligence because of exactly what Kealan was talking about. It's the first step in what we imagine to be, if things go well, a long-term relationship. We're going to invest through our SEIS fund, then we're going to work closely with you at SEIS level, track that progress very closely, and see how the relationship develops and matures, hopefully, rather than falling apart. And then from that point, that's when we'll bring in our EIS fund if things are going in the right direction, and follow on. And then follow on for several years from our EIS fund up to Series A. So we front load a lot of that due diligence, and we do spend a lot of time on it because it's the first chunk, if you like, of what is going to be years worth of interaction and engagement. So we want to make sure it's right and it's a good fit. And it's also borne out in the fact that we don't make that many new investments in any given year. At SEIS level, we're doing maybe 5 or 6 new companies into the portfolio per year. So again, we're going to scrutinize it very closely because we put a lot of time into each one.
Yeah, makes sense. It does make sense. I think it's just, maybe it is some of that that Hollywood glamorization of the way that startup funding works. And I suppose also to give you the founder perspective, which I'm sure you've heard before, but, also for the benefit of the listeners and so on watching, I think it's also a bit like when you're applying for a job. That if you're asked to come to 7 interviews, prepare projects, do, example works and all this sort of stuff for every single one, there comes a point where I just want a job. Like, and they're asking you, why do you pick us? Like, what is it about us that you love so much? You're like, because you pay, you know what I mean? Like, it comes a point where you're just like, I just need the money to get going, man. Like, so I don't know, but then I totally understand the other side of it too. This is very, very important. Like you said, you don't just invest in anyone. You've got, you've got other people relying on you making the best bets possible, and you've got to do whatever you can to mitigate that risk. So I totally get it.
And at the end of the day, if you don't make money for investors, this as a marketplace is not going to survive, right? I mean. Right. If it's just losses after losses, then you do need to be successful as an investor. But I've got a question for you, actually, Greg.
Please.
One of the things that we, a lot of what we thought through, and perhaps that's just a result of experience, but our philosophy and some of our return objectives, etc. We really kind of gave it a lot of thought, and we're pretty loyal to things like what we call our life cycle approach, which Michael alluded to, which is getting involved at an early stage, like a sort of a pre-seed or seed stage, and growing through the journey, and maybe to exit, or maybe another VC or private equity comes in, or a trade sale or whatever. But when we came in, the vast majority of and there's still a lot of people like this, who would describe themselves as early stage venture capitalists, they would say, we're interested when you have $1 million in recurring revenue. Right. And now, do you find that? Do you find that there are people who are just saying,
even those that say, we invest in pre-revenue, and then you speak to them like, we're going to need some revenue. And I'm like, okay, is this just because you don't like me and you don't like the business model, and this is just what you say to get rid of me? Because I'm in sales, I ask follow-up questions, right? That's what you do. You don't just take no for an answer. You find out why. And they said, no, that's just our policy. I'm like, well, all over your website it says you invest in pre-revenue, so you might want to update that. This happens more and more now. I think real pre-revenue, pre-products, pre-seed is pretty much dead for the most part.
It's I guess it's really, you're looking at the traditional friends and family or angel networks, and even some of those are or bootstrapping.
Well, and to your point about angels too, I mean that's just the same now. There are very few angels, at least in my network, and that I know of, that are as bullish on pre-revenue as they were. Right. So now that their line is pretty much the same. It's show me what the traction is in relation specifically to revenue. I mean, not all of them need to see the traction in that way. Obviously, we know that traction comes in many forms, but it's increasingly revenue, even with angels, which it's a bit disheartening. But I think it's it's a tightening of the string purses based on maybe economic limit and so on.
Well, I think that the background macro outlook is a bit worrying, right, and all sorts of fronts, but obviously the technology. I mean, Michael and I were at the BBCA summer tech jamboree, I'm going to call it, and there was a series B and above, and there was a C to Series A, and the Series B Michael went to. I didn't manage to make that. I had other commitments, and Michael was saying it was like unremitting gloom. This is 3 years. This is when the bear market started, because I think a lot changed then. And we were finding at that time that there were valuations. Back then, pre-seed was no problem. In fact, almost everything was getting funded, and at ridiculous valuations. We had companies come to us, and other funds were paying 4 times what we thought was fair value. Now they're all going to lose money, right? But what really what really sort of opened my eyes was one of the panels was talking about early stage funding, sort of for really early founders, like such as your position, and there, the moderator asked a question about the tech bear market, which basically started in the States but quickly spread globally, and one of the questions was, have you ever seen a tech bear market? And everyone on the panel said, no. Almost as if, do they exist? And then I guess to further add to it, he said, does anyone remember 2007, 2008? And one guy said, well, yeah, I started high school that year. And it just really brought it home to roost why durations, because people had unreasonable expectations. So it goes from feast to famine, doesn't it? You have an environment like that, and then now you have an environment, unfortunately, where it's very difficult for really bright new ideas to flourish.
I mean, I've got a bit of a, crazy idea on all this, and I've been speaking with VCs and investor friends of mine about this for years, which is related directly to what I do in my startup, which is I think that we should be looking more at hard skills when it comes to making investment decisions, because if and what I mean by that is if you're looking at a startup, as a potential investment opportunity based solely on whether it's generated revenue, that, as we know, is short-sighted, right? It's not the full picture. But if you were able to determine that the individuals that are currently within the startup, ideally the founders, have the ability to sell, then you can make some sort of prediction as to, basically knowing if I put this money in their hands, they're going to do something with it, along with all other metrics that you need to obviously evaluate. But I think that's a really important one, because if we look back historically through deals that haven't worked during that time frame, it's usually because you've given, individuals have been given money where they've just really had technical skills or very good soft skills and so on, but no real practical skills of understanding how sales and revenue operations as a whole works. And so at the very least, what you can do then is you can identify, okay, you don't have that skill set, but we really love your idea. We really love you. So we'll invest, but only on the contingency that we can bring in our guy or guys to help you with the sales aspect of it. Because if you can't just make that assumption that they're going to figure that out themselves. I think there's a lot to be said for a sort of skills assessment part, which just isn't done. and is obviously what we're trying to bring to the market to some extent. For this exact reason, we're all about the psychometric tests and this, that, and the other, but it's like, just show me what you can do. Can you make money?
Yeah.
It's that simple. Can you make money?
Yeah, it is that simple. And, it's remarkable how many times, one of our sort of mantras is we don't invest in science projects, right? It's great to have great tech, but if you don't have someone who can actually go and sell it, whether that's the CEO or whether that's a dedicated sales and marketing professional, well, what's the point?
Right. And the
From an
interesting
investment point of view.
Yeah, and the interesting, there's an odd paradox here as well, because even the most experienced salespeople who become founders are often terrible at selling their own product. We could go in for hours about the reasons why that's the case, but I think most of them are quite clear, usually because of the sort of tunnel vision that you get from kind of being surrounded by your own idea for so long. So it's a very rare find to find someone that can demonstrate their ability to sell their own product. So you don't just need to identify that they have sales skills as a whole. You need to identify that they have sales skills that can directly apply to the product or service that they are building and selling. And that's really important, I think, because I've talked to a ton of founders that have backgrounds of sales, and they come to me as a go-to-market advisor time and time again and say, great, I don't know what's going on, but when it comes to my own product, I just can't sell it. Give me someone else's and I'll sell it in a heartbeat, but my own is a different story. So yeah, I think it's kind of multi-layered.
Why do you think that is? People who, just a variant on this is, you sometimes get people who are successful at sales in an organization like a Microsoft or whatever, and they're not very good at a startup in the same role, even though they have great sales and a marketing background. But why do you think some people have a hard time selling their own? Because it's counterintuitive, isn't it? Selling their own product. You would think, well, if you can sell Microsoft product or whatever company you're in, why can't you sell your own?
Well, it's because the groundwork's been done for them already quite often, and even so if you're first sales hire number one in a startup, you learn the hard way. It's your role isn't just to go out and be the first salesperson to generate revenue. Your role is to develop the entire sales playbook, which means you need to have a continuous feedback loop between the first customers and your sales playbook, and continue to refine it, and every other form of messaging that your organization creates. And so the headline banner on your website should change every day for the first year of your business, because if you're continuously analyzing your previous interactions and going, okay, when I said that worked. When I described that feature in that way, that didn't work. When I said this word, literally down to, one word in a sentence, and you're continuously refining. And so you take someone that's worked in sales in a startup that's been established for a couple of years, let's say seed or Series A. Well, a lot of that work's been done either by the founders or or at least it should be. And so they're kind of being handed the notes for that, and they're just building on that. You then take them out of that situation, either their own startup or plop them in as a first person, and they're completely lost. And so most founders you speak to that aren't capable of selling their own startup, it's probably because they've never been in a position where they've had to do that. Or if they did, it was 20 years ago. And things have changed, So, and then you add on top of that the fact that you're extraordinarily close to something. It's hard to really, see the forest for the trees. It's hard to know out of, the 5 or 10 different potential go-to-market strategies, which one is the right one. Maybe they're trying too many. I'm guilty of that, or not enough, so there's a lot of things, but at the very bottom of all of that, I think it just comes down to the fundamentals of building that initial version of a go-to-market engine or those motions that is able to create that feedback loop. And it's got to be an iterative process. See, your sales engine is an MVP just as much as your product is, if that makes sense.
No, absolutely.
And that process of discovery is the difficult bit in the early days.
Very.
Like you say, you're trying to hit a bunch of different moving targets, identifying who your ICP actually is, who the correct stakeholders within the organization you should be actually approaching, all this kind of stuff. And we've had 2 board meetings today with companies. We were talking about exactly this kind of thing. And one of the guys who said to me, he actually said something like, I really realized how did he put it? Just founder-led sales, it's a thing. Because I think, as well as the fact that you are, like you said, kind of feeling your way, often in the dark, towards finding what works and who it works with and how to package it, and actually what bit of the product is the right thing to be giving people. Do they need this? Do we need to feed that back? it's also, I think the other place that it probably differs, in my view, is that because it's less formulaic, and because, as you've said, Greg, you're not talking about something that is already a known quantity for whoever you're selling it to. The phrase we often use is that you've got to be an evangelist for the product, more than just a salesperson, because you've got to convince someone, often, especially in the early days, to basically take the risk of taking on a product that may not be there in a few months, or that's still got some kinks to iron out, or, and there's only so many people who are going to be receptive to, hey, be a development partner, be a beta tester, tell us exactly what you want and we'll build it. There will be people who love that, and a lot of companies really rely on that. But there's going to be plenty of people who, almost exactly the same as what you were saying about the people with the money in terms of funding, come back when you're established, come back when you've got some clients on board, and then I'll know that it's a real product, and then we can talk. I can see that it's got value potentially, but so it's not such a straightforward sales process.
It's not. No, it's a completely different sales process entirely. Yeah, and there's no real playbook for that, that exists.
Sorry, I think that's another reason why. Another thing we see a lot in our portfolio is founding teams, either because they recognize that it's not a strength or a skill set that they necessarily already have under their belt, or it's just not something they really want to do and grapple with. They try and bring in salespeople early doors. And I mean, I don't know what, 80-90% of the time it fails.
Yeah.
Because trying to float someone in, however good, again, similar, even if they've got brilliant skills on paper in a more established context, trying to float them into a company that's only got 2, 3, 4 people in it, without that clarity of purpose and vision and product under their belt, very, very difficult for them to be a convincing ambassador for the product in the way that a founder can, because that's where I think the flip side of what you were saying about being kind of saturated in your product. I think a lot of it is about, in our experience at least, or in my experience, is about trying to channel that towards turning it into that kind of evangelism that I was mentioning before.
Yeah.
Turning it into a positive rather than getting bogged down by it and making it, I don't know, an albatross around your neck.
Yeah, well, I mean, it's, in some ways, I think it's even simpler than that as well. Because you're absolutely right, but also, I mean, you wouldn't hire a painting and decorating company to come in and paint your house if you had no idea what color you wanted, which rooms you wanted painting, right? And that's what it is. In some ways, it's even worse than that. It's you hire a painting and decorating company to come in to paint your house, and you haven't even built a house yet. Like it's sometimes it's even that bad. It's like, you just can't do that. And in fact, that's why, sometimes I see a lot of, I don't know, maybe you've had some of these situations, or you've seen these from your contemporaries in other funds and so on. But a lot of businesses fail in those first few critical months, primarily because the founder hasn't done any founder-led sales. It's like you need to hand something over. Like as a career salesperson in my life, I've been that first sales hire for a lot of places, for a lot of founders. And one of my first questions before I start the gig, either as a hire or a consultant or whatever, is what have you done? What has worked? What hasn't? And when you hear, oh no, I haven't really done it, you'll be the person to make us generate revenue. It's like, no thanks. I cannot sell something if you don't tell me how to sell it. I can't do your job for you. What you're asking for is a co-founder. Actually, that's what you're asking for. In which case, give me 50% of the company and a nice hefty salary, and then I'll do it. But you know what I mean. But so it's a different thing, and I think it's I really actively encourage every founder to become like, once you've built the product or a first version of the product, stop building, right? And now focus on developing your sales skills. You need to develop them, even if it's just for the interim. Raising investment is painful enough without getting bogged down in legal costs. That's why I'm using Founder Catalyst, today's sponsor for Peer, my startup's pre-seed raise. We've been lucky enough to have Sam, the CEO of Founder Catalyst, on the show before. Go and check out that episode. Their funding round service offers the most cost-effective way to produce funding round legals in the UK. It's just £1,495 excluding VAT, with no monthly fees or hidden extras, no matter how much you're raising. One Founder Catalyst customer recently raised 2.7 million and saved around £10,000 compared to the next option. If you're looking for SEIS, EIS Advanced Assurance, they've got a 100% success rate over the last 3 years. Founder Catalyst is built by founders for founders, and from my own experience, I can't recommend them enough. You can scan the QR code on the screen around here somewhere or around there somewhere, I don't know, or use the link in the description for 5% off. Thank you to Founder Catalyst for sponsoring this episode. Now back to it. you need to build them.
Yeah, well, absolutely. I mean, it's one of the things that we really spend a lot of time, particularly if we get involved in a kind of pre-seed or seed stage, is evaluating, is this someone who just wants to build products, or are they really thinking deeply about who is there demand for this? Where's the demand? Is the pricing right, et cetera, et cetera? All those typical sort of, well, just fundamentals really of building a business.
Well, that's it. I mean, that's not to say it's not impossible. There's been plenty of founders of startups that have gone on to be very successful or are being successful now, that are not in any way, they're not interested in sales. They've never spoke to a client in their life. They just don't care. They've built the product, they ship, and then they hire people in to do that job for them. It can happen. The point is, it needs to be done in a very specific and structured way. That's the difference, and it does need to be done in that way. At least, and this is just my opinion. I'm not the authority on this by any means, but I believe it would have to be done in a way which is very much on the understanding that it's going to take 6 months for this person to get acclimated. It's going to maybe 8 months. Like, do not, and the expectation, unfortunately, from a lot of founders seems to be, we'll hire a salesperson, we'll give them 1 month to be on board, and then they better be starting closing deals in month 2. It's like, well, not in this particular scenario. So it is possible, but it just takes longer because you need to, I saw an interview recently with Shia LaBeouf, the actor. You familiar with him?
Yeah.
He talked about, he used a great description of what it's like working on a movie set. He said it's like you're trying to realize what the director's dream is. You're trying to understand what that dream is. You don't know. You weren't in the dream, and you're trying your best to understanding what the dream is. I mean, that's a lot what it's like working for a founder, on any level. Even as a co-founder sometimes, if you're not the one that really is the dream weaver. And that takes time,
It's interesting you use that analogy, because one of our companies that's doing something very interesting, the founder was a former movie director. And has shown at Sundance and places like that, the Toronto Film Festival, Cannes, and he refers to his salespeople as like his actors when he was a director. So it's kind of interesting and
that would make sense. Yeah. I think I've long admired the film industry, aside from being a massive movie nerd and stuff anyway, but I've long admired it from just the perspective of just how ridiculous it is as a concept when you think about it. Let's just put this into perspective, right? Someone comes up with an idea for something, let's not even think about the process of writing a script, the revisions it goes through and the years that can take. But then all of a sudden, out of nowhere, an entire group of hundreds, if not thousands of people are put together to do this project. Some of them are all together on set in locations. Some of them are in rooms doing post-production, pre-production, whatever. This entire business essentially pops up. It exists for 8 to 12 months, and then it disappears and it releases a product, and they never come back together again. And it has to work, and it has to work perfectly and produce the vision of maybe a handful of people. That's crazy when you think about it. Can you imagine if it is? Can you imagine you investing in that as an idea for a product? And people do invest in that, right? That's what producers do. But that's talk about risk.
My brother works in the film industry, and
really?
What adds to how just completely crazy it is that it's almost always complete chaos.
Yeah.
The fact that there's any kind of creative vision that is able to be communicated through to all those, like you say, thousands of people on some of these big budget movies, it's nothing short of miraculous. I think it's an interesting parallel, because there's not, you hear about flops at the box office and things, but you don't hear a lot about just, well, that production just completely imploded in on itself because no one could make anything work. Usually you get an end product, even if it turns out to be terrible, or panned by critics or whatever. But just the fact that they get to the end of these projects at all, never mind with a creative, a vision that runs through it, is I don't really understand how it works, because they're so spectacularly disorganized, most of these productions. But I think it's actually a really good, it's an interesting analogy, because, and I think it's telling what you're saying about the company in our portfolio, Kealan, that in the same way that I imagine certain film sets run better than others, and certain films end up being better than others because of the skills of the director. And a lot of that is because it's all well and good having a vision, but it's being able to communicate it clearly and effectively, surrounding yourself with the right people who are on your wavelength, so to speak. And I think that's exactly the same with startups. I talked about this not that long ago with someone else, that's a big part of that decision-making process in the early days is, to the point you were making before about the kind of due diligence, a financial model is going to go out of the window within the week, most likely at this stage, right?
Ours is already redundant.
Exactly, right? No one's going to hold you to it.
Don't tell anyone.
Anyway.
Yeah.
Because it doesn't make sense. It's the same point I made before about forecasting. But what's important to me when I'm evaluating stuff is that you have clarity of vision around it. Not that you're going to be held to that, but that you've thought about it, you've understood what the parameters are going to be, and you've found at least the basis of a way to communicate that clearly and efficiently and effectively. And ideally, if you've got other people around you who have understood that as well and who complement your skill sets and all the rest of it, it's actually very, very similar. I imagine there are plenty of directors who people hate working with because they're just like, yeah, but that's not what I want. Well, tell us what you want. I don't know, but it's not that.
Yeah, figure it out. Yeah,
exactly.
Yeah.
I'm sure it's a very similar thing. Whereas someone who does have that capacity, however, I'm sure there's a million different ways of doing it, but communicating that vision clearly, like you say, when you're trying to describe a dream to someone, is a really good example as well. It's an absolute jumble, but some people are better than others at finding, the way to communicate it in a way that does put you in that place and make you understand it the way they do.
Articulating ideas and concepts is incredibly hard. I mean, and that's also based on the assumption that the person has already entirely formulated them and actually solidified them, which in of itself is an incredibly hard exercise to do. Like, I think we take for granted the ability to think. Not everyone has that ability. Not to take a seed of a concept, to think it through, to stress test it, to interrogate it, and everything, all mentally, before it even gets to a point where you feel ready and secure enough to then articulate it to someone else. That's a very, very difficult process to go through, and then to execute it where you need to continuously reinvent it, articulate it, and get people excited about it. Like that's a whole other challenge. So, to expect everyone to have what it takes to do that is just unrealistic.
And then in addition to that, there's the resilience of the founder, isn't there?
Right.
To be able to say, that's not working, let's pivot. Whether it's a major pivot or a slight pivot. And again, not everybody has that.
Yeah.
And it's absolutely essential in startup world, particularly if you're still trying to prove out, you've got an MVP, say, and you're trying to prove out that there's a market. You've got to have that resilience and that flexibility.
Absolutely. And it's interesting because I always boil down resilience, the ability to be resilient in the sense of being able to pivot and sort of roll with the punches and make good strategic decisions at the right time, as having the ability to be self-aware and to be self-critical and to be reflective and to be able to actually look in and say, am I really doing this because it's the right thing, or is it because of my ego? Like, am I holding on to this because I love it or because it's the right idea? I think that's a big part of it. And actually the founders that are able to pivot at the right moments are the ones that just don't hold on to any of that stuff. They're just like, this is the right thing to do for the business, not because I love that idea and I can't let go of it, whatever, or because of I can't fire that person because I like them, or you know what I mean? It's like, it's the right thing to do. The other thing, I mean, I do love this analogy of film productions and also children. That the analogy of raising children comes up a lot on this show too. But for the sake of today, let's stick with the film production thing, because there's another aspect of that I think is really interesting that doesn't get talked about enough within the startup, especially the founder journey, which is the type of individual and skill set you need at each stage changes drastically. So if we think about a director going to pitch, let's say his movie or his script first, you need to be one way. In pre-production, you need to have a certain skill set and an approach. And then as things go on, you get funded and production starts in earnest and so on and so on and so on, right through to the editing room and then press release and all that kind of stuff. You need to be completely different, and your skill set needs to evolve. And I think this is where, if I may throw a criticism towards venture capitalists, actually where I think those institutions that are funding founders are doing founders a massive disservice in not providing, I would say, the tools and the resources necessary to stay ahead of where they need to be from a skill set perspective and a mindset perspective. They're just thrown into the next stage, and expected to somehow tread water. And I think that's massively unrealistic.
Yeah, I think both Michael and I totally accept that in that why we get involved, because no group has all the skill sets needed. And if there's one thing a VC should be able to bring is if we don't have it internally, have others who can provide that, whatever that may be. That may be anything from understanding that you need a fractional financial controller to, your marketing, or coming to the realization this isn't quite working, there isn't demand here, or you're targeting the wrong sector, or whatever it is. But if you don't have that experience, it's hard to guide people, isn't it? Because, and it's also a lot easier just to give money and then hope the best.
Yeah, absolutely.
From a VC's point of view.
Yeah. But no, I'm glad you mentioned about how hands-on you are, because I did want to ask you about that. So is that generally the kind of, how do you determine then, like, what they need and when and why? Like, is that, how do you come to those conclusions? Is it sort of by asking them directly, by doing an assessment? And do you ever have any instances where you're kind of insisting on providing support on something which maybe they don't believe they need? Or
that does happen.
No, right. Okay.
Not often, thankfully. When it works best, and the way we try to approach it as much as possible, is to kind of give the companies the platform to come to us,
right?
As and when they need us. Because I think a lot of founders, I think sometimes rightly, some of them have been burnt by this in the past. They're very wary of VCs coming in and sort of taking control, and just kind of putting them in shackles. And I've seen term sheets that I understand why people have that concern. So it's always important. Sometimes it's something that we have to deal with when we're kind of getting to the point of investing. When we're trying to negotiate heads of terms to try and allay those fears, that it's not interference for its own sake. It's not we're active because we want to just meddle. If it's not something that's in our wheelhouse, then we'll just let you get on with it. If you're just doing a few months of dedicated product development sprints, we're not going to help you code.
Right. Just
get on with that. That's fine. So I think the first thing to say is we try and let companies lead it as much as possible. That if you want to rely on us and lean on us, then we'll try and make sure we're as available as you need us to be. But if you don't, that's fine. The balancing act, I think, and where sometimes there's occasionally a bit of tension, is that works best when we're still in the loop. We understand what's going on. We often talk about, again, in those kind of negotiations, sometimes people ask, well, how many board meetings is it a year that you expect? So I say, well, quarterly is probably sensible from a corporate governance perspective. You've got my number. Just call me when you've got a question to ask. We shouldn't be finding out about things at the board meeting. Even though even when we're not a board director, if you've got a question or a problem, or there's an interesting, exciting opportunity but you're not sure, does it pull focus? Just give me a ring, drop me an email, and we can have a chat. And then we've got the visibility. I think once you've got the visibility, then it avoids most of those scenarios where you have to, as you were saying, kind of step in and say, well, hang on a minute here. That usually only happens when we've been kept out of the loop, and then they're coming saying, now I've got a problem.
Right, something's degraded as a result of neglecting it, as opposed to getting ahead of it. Yeah.
And I think you'd agree, Kealan, a big part of our job is firefighting. It's trying to clear up messes alongside our founders, and I think that's where we add a lot of value. But ideally, you want to catch them before that. A good example in our portfolio, one company he brought on as a sort of as a co-founder, but after the fact kind of thing, brought on a CTO. They negotiated really hard and really successfully on the vesting clauses and the leaver provisions. And we sort of got told fairly out of the blue that the CTO was now leaving a year and a day after the vesting cliff, or a day after the vesting cliff. So, and we found out about it too late, that their relationship had broken down a couple of months before that, and it was, we said, look, if you just told us,
could have done
told you, hey, that vesting cliff is coming up. Make sure we sort this out. And anyways, it was that kind of thing is when it doesn't work out so well. But by and large, like I say, try and be led by the companies, and some are quite happy to mostly motor along under their own steam, but others really, really rely on us. And it's why we have to keep the portfolio small. Otherwise, we wouldn't be able to do that. But I do find it quite gratifying that when people are sort of ringing you up with like basically personal stuff, especially sole founders. It's like we said before, it's very demanding. And if you're doing it, even when you're doing it with another co-founder, it can be very lonely.
Oh yeah.
So I think just, sometimes it is as simple as just being around, just knowing, like I said, being an open door for them to push on if they need it.
The topic of
parenting analogy there.
No, absolutely, but it's a good analogy. That's why it always comes up. But the topic of loneliness comes up in almost every conversation we have on this show, and I'm glad, because if it's a very important one. I mean, to be honest, I think it's not unique to the startup world. It's an epidemic of the world anyway. But certainly, being a founder is a very isolating job compared to maybe other jobs. Because of the fact that you can't actually be fully transparent as a founder, and you probably shouldn't be, about everything that you're feeling. Because if you were, you would terrify everyone that was working with and for you, to the point where they wouldn't want to work with and for you, right? Like, to say to if you were to be completely honest to like your co-founder or your investors in how you were feeling day to day, they would think you were a lunatic, and you wouldn't be investable. Oh, I think I should pack it all in and quit my, and just go and get a job at McDonald's 1 minute, and the next minute I'm on cloud nine. I just closed the deal. Like, you'd be a lunatic. So, but yeah, I mean, and as you know, when we first met, I told you about my motivations for starting this podcast, and it was based on loneliness, to be able to have the opportunity to have real, honest conversations with people where, like, you're not trying to do your due diligence on me as a founder to well, maybe you are, I don't know, secretly, but like, to see as to whether or not I'm a good investment opportunity. And likewise, I'm not trying to pitch to you. And it's nice to have conversations where there's no agenda. We're just talking. No one's trying to get something from someone, like, and I think that's kind of where a lot of the stress and anxiety and loneliness comes in from a founder perspective, is because there's always an angle. You feel like Del Boy, And
it's very competitive, like we were saying before. I think, I could really get on my soapbox about the way that VC and startups are portrayed in media and a lot of journalism. Is that, the whole sort of Forbes 30 under 30 thing, and faces on the cover of Time magazine. And it makes it such a pressure cooker. Unless you're hyperscaling, unless you're a unicorn within your first 12 months.
I feel that. I get it. It's quite often I'll see, people who I know, founders who I know and respect, they've managed to book this speaking event or, do this, do that. And I think, maybe I should be doing more of that. Maybe I should be doing more of that. And yeah, it's kind of like how Instagram is for young girls. This is the male founder equivalent, or the founder equivalent, I should say, and just that this makes us feel like we're inadequate in what we're doing from a start. And it's never good enough. That's the thing, is, we could be making 10 mil a month, monthly recurring revenue, and it wouldn't be enough, like, because someone else would be doing 20, Yeah.
Well, I think you're quite right to emphasize that, it's like the loneliness of the long distance runner, to throw yet another analogy out there. That is kind of the founding experiences, particularly if it's a sole founder. At least if there's 2 or 3 of them, there's some, people to bounce ideas off. But if you're the sole founder, particularly if you're getting some traction, that's probably where you need a chairman or someone, or the VC, where you can, because you can't necessarily confide everything to everybody. But that really gets to the heart of what I think the founder VC relationship should be. You should be on the same page. Now, that doesn't always happen, but in an ideal world, your interests are very aligned. We spoke earlier in the conversation about the transactional nature of investment banking. This isn't as transactional. It's much more relationship based and working together. And you're in bed together for 5 to 10 years. So you better sort of understand each other, if you like.
Is there any jealousy though? Because you're not the only ones in their bed.
Well, that's true.
Does that ever come up?
Yes. Sorry?
I think, sometimes it rarely in my experience. I think where if we've done our job correctly and we have got involved with the right kinds of founders who hopefully, because of our approach and all the rest of it, by definition, are people who...
If you are enjoying this episode and want to support the show, please like, subscribe with notifications turned on, and let us know your thoughts and opinions in the comments below. This lets YouTube know we are doing something right. Back to the show.
Who value partnership, who value support around them. To your point from before, Greg, they're not ego-driven. They've got the humility to know that I can't do everything. I don't want to do everything. I don't know how to do everything. I want to get the right people around me. If all that's established and that's we haven't all got that wrong up until that point, and it's actually a complete megalomaniac behind the steering wheel of the company.
Like me. Yeah. I'm great at everything. I don't need to hire anyone.
Exactly. If you haven't got that completely wrong, and that's the kind of founder who you're working with, then I'd like to think that for the most part you trust them to make a good call again. If they say, look, I want to bring in this chairperson, or we really want to bring in this this VC because they're really great for our space and whatever. Hopefully we can trust your judgment. And we've done this quite a few times where even ones where we've been quite attached to them and quite actively involved, there's a time when, in the same way that like a CEO might have to step back, a founder might have to step down as CEO because they're not, like you said, it's moving to a different stage. We acknowledge that that's the same thing for us, right? And to Kealan's point, as long as the interests are aligned, which they should be if you've got all this stuff right, I think it would be churlish of us to say, well, no, we still want our board seat, even though we're now 1% of the cap table because you've just raised a £10 million round. I should be jumping for joy that you've raised that money. If it's justified, it indicates that you're on your way to something great. We'll continue to back you, but to the point, to the extent that where it is appropriate now. If that is, I'm in a much more backseat position. I'm not going to throw my toys out of the pram because I'm not. I don't have a seat at the table, at the top table anymore.
Yeah.
Because we should all be working towards the same thing, which is to bring that, whatever the original idea was or whatever it's morphed into over time, bring it to fruition and to an exit so that everyone is rewarded for the work they've put in.
Yeah, kids, the kids grown up and gone to college, right? You've got to it's time to take a step back. Yeah. What would you guys say to the idea of VCs like yours and others maybe providing things like startups, psychology services, or other kind of mental health services as standard, and things like executive coaching as standard? So it's like, this is a non-negotiable for us. If you're taking our money, we want you to see our startup psychologist, once a month or once a week or whatever, almost like an add-on benefit or something like that. Is that the kind of thing that you think? Yeah, would you consider it? Have you considered it? Do you think others should be implementing stuff like that?
We haven't done that in a formal sense, but I think it is definitely something we would consider. We tend to try to look at things like, for instance, one of the services we provide to our, add a bit extra. And we're always trying to think, what can we, and that's a very interesting point about psychology, because there's a lot of psychology involved in a startup. But I mean, for instance, to give you an example, one of the services we offer to our companies, portfolio companies, as a free service is a PR service. So
Right.
we have a PR firm that, because a lot of people, particularly, all startups are incredibly busy, and it's seen as something like a nice to have, but it's quite important, if you along your journey of getting out there in the trade press or whatever your relevant business is. And it's surprising how kind of hard sometimes it is to get people to do this, because understandably they're really focused on getting the product out there and getting the sales going and et cetera, getting the technology ever improving. But that's interesting.
I think that's part of the problem, is that as soon as it goes back to the point I was making before, that as soon as you start trying to mandate things, I think people start saying, well, you're kind of dictating, you're telling me how to run my company, and I don't want that level of interference. Some of those things, because we've had an executive coach on as one of our fund advisors in the past, and we've made good introductions through him. But we've done it on a sort of case-by-case basis. We've got a couple of companies in our portfolio that are in coaching and mentoring and things like that. And again, we've sort of opened up those services to our portfolio companies on a just sort of an introduction basis. So we've never formally sort of insisted upon that kind of thing. And it's a really interesting idea, but I think
like health perks, you get 1 hour of therapy every week and a gym membership, or something like that. And then there's something to help you choose the right foods in your diet. Because I mean, I say this half joking, but I'm half serious, because in a way, I mean, I think that's what I would do if I had a VC fund to some extent, because at the end of the day, it's about mitigating risk and about offering as much support, to to nurture your investment, right? And the investment at the end of the day, it's the founders. So if it's their mental well-being, their physical well-being. So like I would love to see VC firms introducing these kinds of additional benefits as kind of like they're just included. Use them if you want to, but I think most would, because it's like, well, they're there. You've got this. It sounds arbitrary, but even something like a gym membership or some therapy, like just being available on tap for when they want it. It's one less thing for them to have to worry about managing, booking, and so on. It's like it's done. It's booked for you. It's taken care of. Go and take advantage of it, be at your peak physical health, your peak mental health, and that way you can focus on executing on what you need to execute on, Well, and then the other side of it, coaching and so on. Yeah, that's a bit more nuanced, because that's actually getting involved. That's a bit different. But yeah, I don't know. I'm the kind of guy that comes up with stupid ideas all the time. I'm a founder. That's what I do. So sometimes they're good. I don't know. I'm yet to find out. But yeah. Before we sort of wrap up the end of part one, really quickly, I wanted to ask about, you were saying that you guys sort of limit the scope of you're quite picky, right? You only make a certain amount of investments per year. So, I mean, how many different founders and startups are you speaking to on an annual basis to get to, as at the starting point, to whittle it down? And how long does it approximately take you to get from sort of that stage to the stage of knowing whether or not you're going to invest in a company?
I'd say probably on average 3 to 6 months, after we have some interest. When you talk about finding origination, essentially, we get a lot of inbound, but I think most VCs do, right? And a lot of it's very surprising how little work people do on understanding who you are. Maybe because they're just spraying and playing, as it were, and just hitting like 100 VCs. But we could get anyone like completely irrelevant sectors to us coming and approaching us, and so a lot of that is just rubbish. But the best way, rather than inbound, we found either going out and actively, and that could be anywhere. That could be some conferences to angel networks or whatever. Or a lot of the best companies that we have are usually through personal recommendations. We've been doing this for a little while, so we know quite a few people, and some of them, I always, depending on who does the recommendation, but if someone comes and says, I think this would really fit with you, you guys would really get this. I mean, for instance, one of our companies called Digital Clipboard, that basically is working with the wealth management industry and improving productivity and reducing the cost structure of these businesses. That was a recommendation from Microsoft Ventures, who they've actually, we're kind of not in touch with them anymore. They seem to have changed somewhat, but they, the recommendation was, I think you guys would understand this and could really help this company, and that was probably 6 years ago. I'm gonna guess, maybe even longer. Those kind of recommendations are invaluable.
I guess it just goes to
there's
show.
no formula.
Yeah, no, I was just going to say, I guess it just goes to show that's why it's so important for founders to be not too sort of isolated in that sense. It's a really difficult balance to strike as a founder, to go to events and to be, take part in accelerators and this and the other. But it just goes to show that it's good to have some exposure to those things, especially early on in the journey, because you never know who knows who might introduce you to the right person. I mean, networking essentially is what I'm saying, but it is hard because I've got this stage now. I was doing a lot of networking before, and I don't live in London, so I have to drive. It's a couple of hours away. I have to stay over sometimes. It's not cheap, right? And I'm on a startup salary, which is, zero. So I need to be sensible. And then I come to a point really this year where I'm like, okay, I need to calm down the networking. It's been interesting. I've met some great people, some amazing people who are interested in our startup and this, that, and the other. But there comes a point where it can also be a bit of a distraction for just getting on with going to market, from getting on with booking meetings with prospective customers, investors, whatever, right? And it is a hard balance, because I still do feel guilty, or I see an event pop up, I'm like, oh, I should go to that. There might be someone, I know there's someone that I want to speak to there, but then I think it's a lot of investment for maybe I could just send an email, it's a balancing act.
I think the one thing as a founder, what you have to realize is all VCs gets a few hundred emails a day. So something's got to be very distinctive for you to get on their radar. But actually seeing someone, I don't know, being on a panel at one of these events or something, or an accelerator or something, that can really, give you some exposure you might not have had. otherwise. So it is difficult. But on the other hand, most founders have a vision and they want to get it, develop a product, develop the sales and marketing channels, etc. So it's again, I think it comes back to the relationship with the VC. It's well worth having a good relationship if for no other reason that you don't want to be going out there raising money all the time. You really should be focused on your business. And if you can get a good relationship, in particular, our philosophy, as Michael alluded to earlier, of, we set companies KPIs, and then if they meet them, we give them more money and we give them more money. And, rather than cutting a check for 5 million right off the get-go, too often that just gets squandered.
I would definitely squander a check for 5 million. If you gave me a check for 5 million, I have no promises you would ever see me again. I'll be completely honest.
You'd have a nice car to drive to London.
Yeah, exactly. Yeah. I'd be staying at the Hilton the entire time. Yeah. But no, I see your point. I don't know. I guess this is one of the challenges that it kind of goes back to our earlier point about being a founder, that you need to continuously evaluate what your priorities are with the limited information and data points you might have in order to back up that decision-making process. It's very difficult, and it means often you don't make the right decision. But you have to just trust that word again, trust in yourself, and then try and surround yourself with other people that also trust you to a degree, but also aren't just going to agree with every decision you make just arbitrarily, as well. So it's just chaos. I honestly don't know why I do this. I should just work somewhere stable. Maybe I'll work in VC, as we talked about. That sounds stable. We're going to talk in part 2 a bit about where you guys are going and what your plans are. You mentioned before we sort of click record about the team growing, which was really exciting. Definitely want to delve into that a bit more. But I guess before we kind of wrap up this portion as well, I'm really curious to know a bit about kind of what what the impact of AI has had in the last couple of years on you as a fund specifically, not just from the sort of, I guess the boring question would be like, okay, the types of investments you're making and so on. That's interesting to a degree too, but also from an internal perspective, like, has it shifted much of the way you guys work internally, or has it not quite got to that point yet? So I guess it's a two-pronged question there.
Yeah, I think it's certainly something that we have been sort of keeping an eye on. That sounds like we're just monitoring it, as in something we've been thinking about and discussing about, applying it internally. And I think that's been heightened by the fact that we have quite a few AI-heavy companies in our portfolio. At least 80-90% of the decks I see these days, it's something.ai, even if it isn't. So we're pretty saturated in that the whole AI space. So we should be well positioned to try and understand how we can implement it internally, and we've certainly been thinking about it. I think the truth is we're still a bit early in that process. I don't think it's necessarily a technological problem that we need to wait until it can do X, Y, and Z to incorporate it. I think, much like we were saying, a lot of startups, we're also a fairly small business. We're juggling a lot of responsibilities, and you're kind of got to triage your priorities. So it's something that's kind of perennially on the to-do list in the last year or so, but never quite right at the top of that list of priorities. I think where we've thought about trying to really bring it to bear is on what we were just talking about, deal sourcing and filtering.
Top of funnel, that makes sense. I mean, that's where it's being implemented in terms of, go to market, right? It's been implemented top of funnel, AI SDR, that's the frontline stuff, right? So yeah, it makes sense. Yeah,
because that is a time-consuming process, and like Kealan says, a lot of it is pretty low value. But also, it's not just about increasing the efficiency and just getting through the pitch decks and things, but also like identifying stuff at the right time. But by contrast to what you were saying earlier, we're constantly looking for things as early as possible, because the really good opportunities, if you don't act quickly, you've missed the boat a lot of the time. So a lot of it as well is about trying to identify the right kinds of companies that are a good fit for us early, approach them early, and kind of move them through that process quickly. The other place that we have used it is sort of more, we've used it for some internal bits and pieces. We've been using it lately, I predominantly myself, we've been using it as a tool to help pull some like research projects together. We're trying to, as part of a broader project that ties into the expansion that you mentioned. We're trying to overhaul a lot of our documentation and reevaluate, because now that we've got more sort of track record under our belt, the assumptions that Nick and Kealan started the business with, do they still hold true? Do we need to update that? And yeah, I've been using it a lot for trying to, as someone who doesn't come from this kind of background, help build out statistical models, return models that I can sort of play around with and do some scenario analysis and make it seem like I know what I'm talking about, rather than I'm, someone who has absolutely no mathematical or statistical credentials whatsoever. And for that kind of thing, it's really powerful, especially in an industry like this, which is some of it's pretty opaque. Trying to look for historical performance data and try and split out US versus UK, it's not as simple as it should be. And actually having something like ChatGPT or Claude, from a couple of prompts, try and pull stuff together for you. Some of this stuff would have taken me days to try and pull together. So it's been really useful for that. And I think that's, for me at least, I think that's quite important, because if you're not constantly, again, same as it would be for a startup, I take the same approach for us internally. If you're not constantly questioning and iterating and making sure that you're on the right track and questioning yourself about that, then very easy to just sort of wake up one day and go, oh, whoops, we've completely missed the mark.
Right, and then you can fall behind, and you've got competitors, right? It's no different from any other business in that sense. You miss out on the best deals at the best valuations and all that. Yeah, by the sounds of it, it's sort of the agenic movement that could be most useful for you guys, essentially, to go out and, like you say, perform research tasks and do the sort of comparative data analysis and all that kind of thing. But to throw another one of my crazy ideas at you, the thing that I've been thinking about for a while in speaking to the VCs I have over the years is I think there's definitely a missed opportunity in a lot of funds with using AI internally to assess and analyze what's going on within portfolio companies to see if there are synergies between them for mutual benefit and mutual gain. That's something that I think is often missed, because it's usually done sort of quite more intuitively or off the cuff when you're speaking, getting an update from one, maybe having a coffee and they mention something that you heard the other one say last month. You go, oh, wait a minute, I remember. But if there are definitely ways, I think, of getting AI to be a lot more proactive in that sense, to pick up on things and to the sharing of resources, the sharing of knowledge. It's like, why go out and do that thing from scratch if these guys have done it? It's like that kind of thing. I think AI can be very beneficial there to almost act as this kind of interface between portfolio companies in that sense. That's one that I would be quite bullish on if I was in VC, for example.
Yeah, I think that makes a lot of sense for the bigger fund managers. If you've got a portfolio of 100, 200, 500 companies, you're not going to have the same level of oversight as to what they're all doing and where they're all at. Probably siloed across different teams who are managing different portions of that portfolio.
Right.
And so for outfits like that, I think that's potentially hugely valuable, because we say this all the time. I think for an outfit like us that we've only got 40 active companies at any given time, it's still more than manageable, and because we're quite deeply embedded in them, it's much easier to keep track of who's doing what and introduce the right people to the right people. But once you start operating it at a scale that's just not feasible anymore, you're missing out on value creation, to your point. But the other thing that you mentioned, we say this to companies all the time, there's no point spending time and money when you're stretched for both to build something that someone else has already made. Partner up, find a way to collaborate.
Yeah, there's partnerships, integrations, customer sharing, value sharing. Like, there's so many opportunities there. I would argue, even at a size of like 40 to 50 companies, that's still sort of thing, because essentially it's community management. That's what you end up sort of almost veering into the territory of. And community management is quite a complex thing. And there are tools. One of my investments is an angel investor, funnily enough, and I'm a board advisor for, is kind of in that space for the creator economy. And they're going to be moving into, sort of community management for startups. So startups that need to build a community as part of their customer base kind of thing. And there's some really interesting stuff going on in AI there in the way that it does similar things to what we're saying, in sort of, listening to context of conversations from one part of the community, one individual, and recognizing that someone's mentioned something similar and making introductions and stuff like that. Like, almost like a Cupid, kind of thing. Like, I love that concept. And I think that, because if that time is freed, whether you've got 10 people to manage in a community or 1,000, at the end of the day, that time is saved to then go and do other stuff, regardless. So yeah, interesting. Well, look, that's the end of part 1. That went by incredibly quickly. So we're going to take a short break. But for those listening and watching, thank you. And come back in a couple of days, subscribe, notification bell on, so it's all that sort of stuff. So you get notified when part 2 drops. It will be in a couple of days, usually is. So that's the end of part 1.
Thank you for listening and or watching. Subscribe with notifications turned on to get notified when part 2 comes out. While you wait, please join in the conversation in the comments below.